Welcome back, my friends. The news today is that Berkshire Hathaway CEO Warren Buffett has now published his annual letter to shareholders. And as usual, it includes a lot of insights into how he views the world of investment and the overall economy. Berkshire Hathaway is the largest and best-known conglomerate in the world today. Its holdings include entire companies, like Geico and the Burlington Northern Santa Fe Railroad, as well as stakes in public companies like Apple and Coca-Cola. Berkshire Hathaway posted operating earnings, which refers to profits from businesses across insurance, railroads, and utilities, of $8.481 billion in the fourth quarter. This video includes excerpts from the annual letter, as well as some related commentary from me. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to buy me a coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. As usual, the Buffett's annual letter includes a lot of personal stories about particular shareholders, employees of the company, or acquaintances of Buffett. I'm leaving those parts out of this video to focus mainly on the investment-related parts of the letter. Buffett states that at Berkshire our view is that earnings should be a sensible concept that Bertie will find somewhat useful, but only as a starting point in evaluating a business. Operating earnings for Berkshire Hathaway were $27.6 billion for 2021, $30.9 billion for 2022, and $37.4 billion for 2023. The primary difference between the mandated figures and the ones Berkshire prefers is that we exclude unrealized capital gains or losses that at times can exceed $5 billion a day. Make no mistake about the significance of capital gains. I expect them to be a very important component of Berkshire's value accretion during the decades ahead, said Buffett in the letter. He continued by saying, "I can't remember a period since March 11, 1942, the date of my first stock purchase, that I have not had a majority of my net worth in equities, US-based equities. And so far so good." The Dow Jones Industrial Average fell below 100 on that fateful day in 1942 when I pulled the trigger. I was down about $5 by the time school was out. Soon things turned around and now that index hovers around 38,000. Buffett has stated over and over again that America has been a terrific country for investors. This year saying, all they have needed to do is sit quietly, listening to no one. It is more than silly, however, to make judgments about Berkshire's investment value based on earnings that incorporate the capricious day-by-day, and yes, even year-by-year movements of the stock market. As Ben Graham taught Buffett, in the short run the market acts as a voting machine. In the long run it becomes a weighing machine. The goal at Berkshire is simple. We want to own either all or a portion of businesses that enjoy good economics that are fundamental and enduring. And Berkshire does not win on all of its investments. Buffett states, within capitalism, some businesses will flourish for a very long time while others will prove to be sinkholes. It's harder than you would think to predict which will be the winners and losers. And those who tell you they know the answer are usually either self-delusional or snake oil salesmen. At Berkshire, we particularly favor the rare enterprise that can deploy additional capital at high returns in the future. Owning only one of these companies, and simply sitting tight, can deliver wealth almost beyond measure. Even heirs to such a holding can, sometimes live a lifetime of leisure, said Buffett. We also hope these favored businesses are run by able and trustworthy managers, though that is a more difficult judgment to make, however. And Berkshire has had its share of disappointments, he continued. In 1863, Hugh McCulloch, the first comptroller of the United States, sent a letter to all national banks. His instructions included this warning: never deal with a rascal under the expectation that you can prevent him from cheating you. Buffett observed that many bankers who thought they could manage the rascal problem have learned the wisdom of Mr. McCulloch's advice. Buffett also added this about his view on people. People are not that easy to read. Sincerity and empathy can easily be faked. That is as true now as it was in 1863. This combination of the two necessities I've described for acquiring businesses has for long been our goal in purchases, and for a while we had an abundance of candidates to evaluate. If I missed one, and I missed plenty, another always came along. According to Buffett, Berkshire Hathaway now has by far the largest GAAP net worth recorded by any American business. GAAP stands for Generally Accepted Accounting Principles. Record operating income and a strong stock market led to a year-end figure of $561 billion. The total GAAP net worth for the other 499 S&P companies, a who's who of American business, was $8.9 trillion in 2022. By this measure, Berkshire now occupies nearly 6% of the universe in which it operates. And, Buffett adds this important observation, doubling our huge base is simply not possible within, say, a 5-year period, particularly because we are highly averse to issuing shares, an act that immediately juices net worth. There remain only a handful of companies in this country capable of truly moving the needle at Berkshire, and they have been endlessly picked over by us and by others. Some we can value, some we can't. And if we can, they have to be attractively priced. Outside the U.S., there are essentially no candidates that are meaningful options for capital deployment at Berkshire. All in all, we have no possibility of eye-popping performance, added Buffett. Berkshire Hathaway now owns either a portion or 100% of various businesses that, on a weighted basis, have somewhat better prospects than exist at most large American companies. And Berkshire's portfolio includes a few huge winners have emerged from a great many dozens of decisions. Berkshire also employs a small cadre of longtime managers who never muse about going elsewhere and who regard 65 as just another birthday. Buffett points out that he expects Berkshire to do a bit better than the average American corporation, and more important, should also operate with materially less risk of permanent loss of capital. Anything beyond slightly better, though, is wishful thinking, and, he adds this important little point, our not-so-secret weapon occasionally. Markets and/or the economy will cause stocks and bonds of some large and fundamentally good businesses to be strikingly mispriced. Indeed, markets can and will unpredictably seize up or even vanish as they did for 4 months in 1914 and for a few days in 2001. Instant panics in the market won't happen often, but they will happen. Buffett points out that Berkshire's ability to immediately respond to market seizures with both huge sums and certainty of performance may offer us an occasional large-scale opportunity. Though the stock market is massively larger than it was in our early years, today's active participants are neither more emotionally stable nor better taught than when I was in school. For whatever reasons, markets now exhibit far more casino-like behavior than they did when I was young. The casino now resides in many homes and daily tempts the occupants, according to Buffett. He adds this important observation: one fact of financial life should never be forgotten. Wall Street, to use the term in its figurative sense, would like its customers to make money. But what truly causes its denizens' juices to flow is feverish activity. At such times, whatever foolishness can be marketed will be vigorously marketed. Not by everyone, but always by someone. Occasionally the scene turns ugly. The politicians then become enraged. The most flagrant perpetrators of misdeeds slip away, rich and unpunished. And your friend next door becomes bewildered, poorer and sometimes vengeful. Money, he learns, has trumped morality, Buffett adds. One investment rule at Berkshire has not and will not change: never risk permanent loss of capital. Thanks to the American tailwind and the power of compound interest, the arena in which we operate has been, and will be, rewarding if you make a couple of good decisions during a lifetime and avoid serious mistakes. According to Buffett, I believe Berkshire can handle financial disasters of a magnitude beyond any heretofore experienced. When economic upsets occur, as they will, Berkshire's goal will be to function as an asset to the country, just as it was in a very minor way in 2008-9, and to help extinguish the financial fire rather than to be among the many companies that, inadvertently or otherwise, ignited the conflagration, Buffett adds in the letter. Berkshire Hathaway's strength comes from its constant flow of diverse earnings delivered after interest costs, taxes and substantial charges for depreciation and amortization. EBITDA is a band measurement at Berkshire. For those of you unfamiliar, EBITDA is an acronym that means earnings before interest, taxes, depreciation, and amortization. Buffett also refers to EBT as earnings before all of the bad stuff. Companies in the portfolio of Berkshire Hathaway also operate with minimal requirements for cash. Even if the country encounters a prolonged period of global economic weakness, fear, and near paralysis. A lot of investors have called upon Berkshire Hathaway to pay dividends, but Berkshire does not currently pay dividends, and its share repurchases are 100% discretionary. Berkshire Hathaway stores its huge cash pile in U.S. Treasuries and holds a cash and U.S. Treasury bill position far in excess of what conventional wisdom deems necessary. During the 2008 Great Financial Crisis, Berkshire generated cash from operations and did not rely in any manner on commercial paper, bank lines, or debt markets. We did not predict the time of an economic paralysis, but we were always prepared for one. Extreme fiscal conservatism is a corporate pledge we make to those who have joined us in ownership of Berkshire. In most years, indeed in most decades, our caution will likely prove to be unneeded behavior, akin to an insurance policy on a fortress-like building thought to be fireproof. Added Buffett in the letter, Berkshire Hathaway does not want to inflict permanent financial damage. Quotational shrinkage for extended periods can't be avoided. According to Buffett, Berkshire Hathaway is built to last. Two particular non-controlled businesses that mentioned in the letter include Berkshire's long-duration partial ownership positions, Coca-Cola and American Express. Both companies have long histories, even before their shares were owned by Berkshire Hathaway. Both Coke and American Express became recognizable names worldwide, as did their core products, and the consumption of liquids and the need for unquestioned financial trust are timeless essentials of our world. During 2023, we did not buy or sell a share of either American Express or Coke, extending our own Rip Van Winkle slumber that has now lasted well over 2 decades. Both companies again rewarded our inaction last year by increasing their earnings and dividends. Indeed, our share of American Express earnings in 2023 considerably exceeded the $1.3 billion cost of our long-ago purchase, the letter said. Pretty much every observer thinks that American Express and Coke will almost certainly increase their dividends in 2024, about 16% in the case of American Express. Buffett says that he expects that Berkshire will most certainly leave our holdings untouched throughout the year. Though Berkshire did not purchase shares of either company in 2023, the company's indirect ownership of both Coke and American Express increased a bit last year because Berkshire Hathaway actually repurchased some of its own shares off of the open market. And as most of you already know, Warren Buffett is a big fan of share repurchases by companies. Such repurchases work to increase investor participation in every asset that Berkshire owns. To this obvious but often overlooked truth, I add my usual caveat. All stock repurchases should be price dependent. What is sensible at a discount to business value becomes stupid if done at a premium, says Buffett in the letter. The lesson from Coke and American Express? When you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable, Buffett states. In the letter, Buffett also highlighted a couple of other companies that Berkshire holds in its portfolio. At the end of 2023, Berkshire owned 27.8% of Occidental Petroleum's common shares. Berkshire also owns warrants that, for more than 5 years, give Berkshire the option to materially increase its ownership at a fixed price. Though we very much like our ownership as well as the option, Berkshire has no interest in purchasing or managing Occidental. We particularly like its vast oil and gas holdings in the United States, as well as its leadership in carbon capture initiatives, though the economic feasibility of this technique has yet to be proven, according to Buffett. In the letter, Buffett points out that both of these activities are very much in our country's interest. Not so long ago, the U.S. was woefully dependent on foreign oil, and carbon capture had no meaningful constituency. Back in 1975, U.S. production was 8 million barrels of oil equivalent per day, BEPD, a level far short of the country's needs. Today, the U.S. produces over 13 million barrels of oil per day, but actually uses about 19 million barrels per day. From the favorable energy position that facilitated the U.S. mobilization in World War II, the country had retreated to become heavily dependent on foreign, potentially unstable suppliers. Further declines in oil production were predicted along with future increases in usage. For a long time, the pessimism appeared to be correct, with production falling to 5 million BOEPD by 2007. The U.S. government created a Strategic Petroleum Reserve, SPR, in 1975 to alleviate, though not come close to eliminating, U.S. production is more than 13 million BOEPD, and OPEC no longer has the upper hand. Occidental itself has annual U.S. oil production that each year comes closer to matching the entire inventory of the SPR. And don't forget, shale production of oil became economically feasible in 2011, which led to the boom in U.S. oil production. Our country would be very, very nervous today if domestic production had remained at 5 million barrels per day, and it found itself hugely dependent on non-U.S. sources. At that level, the Strategic Petroleum Reserve would have been emptied within months if foreign oil became unavailable. Under Vicki Hollob's leadership, Occidental is doing the right things for both its country and its owners. No one knows what oil prices will do over the next month, year, or decade. But Vicki does know how to separate oil from rock, and that's an uncommon talent, valuable to her shareholders and to her country, said Buffett in his letter. Additionally, Berkshire continues to hold its passive and long-term interest in 5 very large Japanese companies, each of which operates in a highly diversified manner, somewhat similar to the way Berkshire itself is run, Buffett continued. Berkshire Hathaway increased its holdings in all 5 last year after Greg Abel and I made a trip to Tokyo to talk with their managements. Berkshire now owns about 9% of each of the 5. Here is the full-year compilation. In million, insurance underwriting. She. 5428-30. Insurance investment income. 9557-6 Railroad. 50. 5 and 5 946. Utilities and energy. Seba. 23904. Other businesses and miscellaneous items. 14,937, 14,549. Operating earnings. ASA. 37,350, 30,3. And as just sort of a commentary on owning the largest U.S. railroad, Buffett commented that rail is essential to America's economic future. It is clearly the most efficient way, measured by cost, fuel usage, and carbon intensity, of moving heavy materials to distant destinations. Trucking wins for short hauls, but many goods that Americans need must travel to customers many hundreds or even several thousands of miles away. The country can't run without rail, and the industry's capital needs will always be huge. Indeed, compared to most American businesses, railroads eat capital. BNSF is the largest of 6 major rail systems that blanket North America, continued Buffett in the letter. The BNSF Railroad carries its 23,759 miles of main track, 99 tunnels, 13 495 bridges, 7 521 locomotives, and assorted other fixed assets at $70 billion on its balance sheet. And it would cost at least $500 billion to replicate those assets and decades to complete the job. BNSF must annually spend more than its depreciation charge to simply maintain its present level of business. This reality is bad for owners, whatever the industry in which they have invested, but it is particularly disadvantageous in capital-intensive industries. Berkshire Hathaway's second and even more severe earnings disappointment last year occurred at Berkshire Hathaway Energy, or BHE. Most of its large electric utility businesses, as well as its extensive gas pipelines, performed about as expected. But the regulatory climate in a few states has raised the specter of zero profitability, or even bankruptcy. As a matter of fact, that was an actual outcome at California's largest utility and a current threat in Hawaii. If you recall, Pacific Gas and Electric, California's largest utility, has filed for bankruptcy twice in its history. One time about 5 years ago, and Hawaii's gas and electric business environment has become somewhat inhospitable to investor-owned utilities because of government subsidies for solar energy. Just as my own commentary, I am not so confident that the investment climate for gas and electric utilities is that great here in the United States. In California, public utilities continue to raise gas and electric rates to what I think are unacceptable levels, and there will be a severe political backlash if things continue on this trajectory. In such jurisdictions, it is difficult to project both earnings and asset values in what was once regarded as among the most stable industries in America. For more than a century, electric utilities raised huge sums to finance their growth through a state-by-state promise of a fixed return on equity, sometimes with a small bonus for superior performance. With this approach, massive investments were made for capacity that would likely be required a few years down the road. That forward-looking regulation reflected the reality that utilities build generating and transmission assets that often take many years to construct. BHE's extensive multi-state transmission project in the West was initiated in 2006 and remains some years from completion. Eventually, it will serve 10 states, comprising 30% of the acreage in the continental United States. With this model employed by both private and public power systems, the lights stayed on, even if population growth or industrial demand exceeded expectations, according to the letter. The margin of safety approach seemed sensible to regulators, investors, and the public. Now the fixed but satisfactory return pact has been broken in a few states, and investors are becoming apprehensive that such ruptures may spread. Buffett said in the letter, climate change adds to their worries. Underground transmission may be required, but who a few decades ago wanted to pay the staggering costs for such construction? Berkshire Hathaway has made a best estimate for the amount of losses that have occurred. These costs arose from forest fires, whose frequency and intensity have increased, and will likely continue to increase if convective storms become more frequent. It will be many years until we know the final tally from BHE's forest fire losses and can intelligently make decisions about the desirability of future investments in vulnerable western states. It remains to be seen whether the regulatory environment will change elsewhere, said Buffett. Other electric utilities may face survival problems resembling those of Pacific Gas and Electric and Hawaiian Electric. A confiscatory resolution of our present problems would obviously be a negative for BHE, but both that company and Berkshire itself are structured to survive negative surprises. I think that certain utilities might no longer attract the savings of American citizens and will be forced to adopt the public power model. There are many public power operations throughout the country. Eventually, voters, taxpayers, and users will decide which model they prefer. When the dust settles, America's power needs and the consequent capital expenditure will be staggering. Buffett continues by adding, "Our insurance business performed exceptionally well last year, setting records in sales, float, and underwriting profits. Property casualty insurance, PC, provides the core of Berkshire's well-being and growth." But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions, doctors, including any type of specialty, nurses, and that includes all grades of nurses, lawyers, regardless of area of legal focus, teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.